Okay, so we're now at the conclusion of our chapter 6 video lecture. We're going to move on next to what we call natural resources in a process known as depletion. Let's get right into it. So we paid for a coal mining $4 million to purchase a mine with an estimated 16 million tons of coal. So your depletion charge is going to be 25 cents per ton. So every time we deplete tons of coal, we'll take that times 25 cents to get them out of our depletion expense. All right. So in the first year, we depleted a total of 360,000 tons of coal. So in our balance sheet, assume we paid cash to purchase the mine. First, the cash account decreased by 4 million. The coal mine, which is an asset, increased by 4 million. That 4 million will be shown as an outflow of cash as an investing activity. So now, at the end of year one, we depleted a total of 360,000 tons of coal. Take the 360 times 25 cents per ton. Your depletion expense will equal $90,000. So the coal mine account will decrease by 90,000. Retained earnings will decrease by 90,000, and that's because your expenses just increased by 90,000, giving us at that time a net loss. Okay? So that's pretty much how you handle depletion expense. You will first determine your depletion rate per unit, multiply times the unit depleted to get the amount of your depletion expense. That's all. Last topic is intangible assets. Intangible assets. So these are assets that don't necessarily have a physical presence, but when you own these assets, you have certain rights and privileges as being the owner of these intangible assets. Those rights and privileges come with a value. For example, a trademark is a name or a symbol that identifies a company or a product. So when we're talking about Gucci, Range Rover, uh, you know, Samsung, iPhone, Apple, a trademark is a name or a symbol that identifies a certain company. That trademark actually has value because, as you all know, often we'll pay a higher price for a product just because of the actual trademark or brand name for that product. We'll talk more about that. A patent is a grant, also not a grant, a patent grants the owner an exclusive legal right to produce and sell a product that has one or more unique features. The legal life of a patent is 20 years. So, if you were to develop a product today and got that product patent, then no competitor can copy your product exactly that same format without you suing them because you, as the patent owner, has exclusive right to produce and sell that product. Now, once that patent expires, yes, the competition can, at that point in time, duplicate your product. That's why often when you see these generic drugs, they're the same as the brand name drug, except now the brand name drug's patent has expired, and those competitors now are able to produce the actual same product. Okay? A copyright deals with works of art, music, composition, writings, where again, if you are a songwriter and you write a song, get it copywritten, you have the exclusive rights to that particular information. All right. You can allow someone else to sing your song at a cost. You can sing it yourself. But again, if it's copywritten, then you have the exclusive rights to those lyrics, composition, or work of art. Now, the copyright is extended for the life of the creator plus 70 years after their death. Meaning that if Michael Jackson wrote a song that you like, and now you say, well, you know what? I'm going to remake that song. Nope, you can't do that because the creator, the patent, the copyright is protected for not just the life of that creator, also 70 years after their death. Okay? Franchises. Whether it's a McDonald's franchise, Subway, etc. A franchise gives exclusive right to sell products or services in certain geographical areas. So if you want to become part of the McDonald's family, you might go see Ronald McDonald and you would pay a franchise fee to that corporation. Okay? Goodwill. What is goodwill? Well, goodwill is not a good deed. And so I'm going to explain goodwill because it can be somewhat complex. So I'm going to give an example. And from the example, we're going to use the example to explain what goodwill actually represents. Okay? So goodwill, we look at what we call certain attributes, favorable factors, such as a company having a good reputation, they're being in a great location, they may have great customer service, provide a superior product. Goodwill can only be recognized from the acquisition of a business. Again, goodwill can only be recognized from the acquisitions of a business. For example, suppose the accounting records of a restaurant named Bedingo show the following. They have assets for 200,000, debt of 50,000, equity of 150. So remember those numbers: assets 200,000, liability 50,000, equity of 150. Okay? Assume a buyer agrees to purchase the restaurant by paying the owner 300,000 cash and assuming their existing liabilities. Okay? Which means the purchase price is going to be $350,000. Now, the company's assets have been appraised and have a fair market value of $280,000. So when you acquire this restaurant, all those assets minus the liabilities, I'm gonna put it out there, have a value of $280,000. The question is, why would the buyer pay $350 instead of $280? Well, they're paying the $350 because of those goodwill factor we talked about. This restaurant may have been established for the past 20 years. Again, they could have great customer service. They already have a client list. People know what the food tastes like. They love the service they receive there. So you have to pay me for my goodwill attributes that I have developed over the years. You can't just pay me for those tangible assets like the building or equipment, etc. You got to pay me for my customer list, my reputation, because what happens that with this situation, you're buying an established business, therefore you're going to come into a business where you're going to have customers right away because they're familiar already with the actual restaurant. So that excess of the purchase price over the asset's fair market value is known as goodwill. So to record this transaction, and this would be on the books of the new owner, they're going to decrease cash $300,000. They're going to record the assets at their fair market value of the 280, recognize goodwill of 70,000, and they also assumed the debt of their old company for $50,000. So they got more liabilities now, and on statement of cash flow, they're going to have an outflow of 300,000 as an investing activity. Okay. Now, certain intangible assets, if they have what we call a defined useful life, meaning that it's not indefinite, they go through a process known as amortization, which is similar to depreciation or depletion. It means that the cost of those intangible assets becomes an expense over time through a process known as amortization. Okay? So there's only certain type of intangible assets that have a defined useful life, and it is those assets that go through a process known as depreciation. Look at an example. So, for example, a patent has a legal life of 20 years. However, it may only have a useful life of 11 years. And let me expound upon that. Let's say that you wanted to develop this new product. You get a patent in the early stage of development. It may take you 4 or 5 years to develop that product due to testing and things of that nature. So the patent lasts 20 years, but it took you maybe 5 years to develop. So you only have 15 years remaining as what we call the asset's useful life. In this situation, there's only 11 years remaining. So therefore, if our patent cost was $44,000, if we paid $44,000 for fees for the patent, what have you, then your cash account decreased by $44,000. Your patent account will increase by $44,000. Now you're going to amortize that cost over the next 11 years. We call this straight line amortization. So just 44,000 divided by 11,000. So you're going to expense $4,000 each year. So your patent account would decrease by 4,000 each year. Retained earnings goes down by 4,000 each year because that's an expense. All right. So if you have an intangible asset with an identifiable useful life, then the cost of that asset will be amortized over the asset's useful life, not over its legal life. Okay. Last thing, although an intangible asset may have an indefinite useful life, it can become impaired. Impairment means an asset has suffered a permanent decline in value. Again, impairment means an asset has suffered a permanent decline in value. For example, what if those goodwill attributes that we discussed earlier are no longer there? The location is no longer favorable. The customer service is not good. Things of that nature. So here we're saying that assuming that their goodwill has a current fair value of 40,000. Remember, we initially recorded that for 70,000. So with an impairment loss, it means there's a permanent decline in value, and we don't see that changing anytime in the foreseeable future. So if an asset has become impaired, we then have to make an adjustment. So now that goodwill account will be decreased by 30,000, retained earning decreased by 30,000, and you'll recognize a loss on impairment, which is like an expense, in the amount of $30,000. Okay, so now on the balance sheet, you're showing your building less any accumulated depreciation, can get the word out. You're showing your natural resources, less any depletion. And then when it comes to your intangible assets, they don't have a contra account, but as they're being amortized, the amortization directly reduces the actual value of those intangible assets. Okay? So I hope you have enjoyed these lectures on chapter 6 covering long-term operational both tangible and intangible assets. Okay? Have a nice day.